Yeah, it's really, really hard.
1, 2, 3, all eyes on me. Thank you so much.
Used to be a teacher, huh?
I have not been, but I have children, so there's that. Alrighty, awesome sauce, you guys. My name is Patrice Johnson, CEO and President of Makarios Capital and Financial Services. So like I mentioned earlier about times changing, disruptions into the society, if you will. I think about things that have changed recent years for us, right? We went from trying to get a taxi. I'm still waiting for the taxi to pick me up at the bar probably 6 or 7 years ago. It never showed up. Because now we have what? Uber and Lyft and several others that have come from it. Those have disrupted and changed how we have looked at.
Uber is a great show on Netflix. I know that pretty well.
And Uber is how I met my husband. I picked him up
really?
drunk one night. So there's also
phenomenal.
there's also that.
Oh, I want to hear
So
that story.
a lot of good things come from Uber. We'll follow up on that one. So I like to say it's the longest ride. And so with that being said, and then we also have Airbnb, Verbo, all of these things that have disrupted the industry. And one thing that has not changed has been retirement. For so long, we have traditional used vehicles like 401ks, IRAs, Roth, these things, because that's all we know. I think of that as like a authoritative information. It's something that we have traditionally done, so sometimes it's hard to break the mode, especially when you bring something else to the forefront that really goes, wait a minute, is there a catch? When realistically, everything we do is going to have a catch, even the vehicles that we use now with all the hidden fees and things that you are not made aware of. All right, next one. All right, so now, we have about 3 categories. Obviously, this is not all inclusive and things of that nature. This is just an example, so now getting panties in a bunch here. So when we talk about taxes, fees, things of these things, there's a now, later, and exempt. So when we think of now, these are things that we take our after-tax dollars and we place them into these vehicles to grow. These usually have low risk, depending on what you're using, where, hey, you're only participating in the upside and the downside, none of that, you're given a dividend, whatever it is, checking accounts, savings, CDs, guaranteed interest rates, things of those natures. Then when we talk about later, these are our traditional vehicles that we know about, 401ks, 403bs, IRAs, 457, etc. Whew, I am out of breath talking so fast, y'all.
It's okay to slow
I'm gonna
down.
get there, I'm gonna
It's
slow
okay to
down.
slow down.
And then we have our tax, our exempt ones, right? So we're using our after-tax dollars to contribute to these vehicles so that when we go to retire, whatever you made to pull out money, we are not taxed on that money again. So here we go with that. Oh, next one. The catch, right? So what is the catch to the traditional vehicles that we have always known? It's not so much that it's a catch. Some of those things we never actually integrated, asked those kind of questions, whether we knew or didn't know, or just didn't have the resources to do so. So when we think about 401ks, IRAs, all these things, these are great vehicles, but they all have contribution limitations. Meaning if you wanted to contribute more, you would have to find an alternative vehicle, or you're just kind of SOL. Because what they don't tell you about the 401k, I actually did some research on the IRS website, if you max overfund it, you are double taxed, and they're not gonna tell you. You have to figure that out yourself. So depending on jobs, like most people aren't contributing $23,000 to their 401ks, because that's just not how society is working. But in the instance that you are able to hit that match and your job is also matching, those are things that are going to push you towards that red line where they will double tax you and they will not tell you. It says that on there, it says, play at your own risk in the IRS side in so many words. And then in terms of flexibility, there's not a lot of flexibility when it comes to these options. So when you have, if you don't have a hardship, it's going to be very hard to access this money, right? So you might have something that does not fall into the categories. Guess what? Uncle Sam's like, okay, Ann, I'm going to go ahead and charge you 10% for pulling that money out extra. Additionally, you have to consider you didn't pay taxes on those vehicles yet. So when you talk about taking money out of your 401k, you, depending on your tax bracket and where you are in your life when this event happens to you, your tax bracket can be very different. Kids could probably just graduate, finally get off your health care plan. You can no longer use them as a tax write-off to help lower your tax implications, for the lack of a better word right now. And then in terms of restrictions, so you can only get a 1-year look back on these vehicles if you wanted to go back and fully fund them, right? Say you get an inheritance, you come into some money, maybe you win the Who's lottery, right? So you could not go back any further into those vehicles. You can only go 1 year back. And then fees, administration, overage, all these things. Even with a 401k, you're looking at a 1.5 administrative fee. So even when you win, you're losing, period. So I actually have, I'm probably not gonna show it today, I have a vehicle that me and my husband created on Excel, where I have how the market has performed in the last 23 years against how ours has historically performed. When we look at that, last year we had a negative 17.29% loss in the market. Knowing that this year in 2023, anyone can answer, what does the market need to do in order for you to basically break even from the loss last year? Just guess. I mean, whatever.
Increase 20%.
I mean, no, you're 100%. You're almost right. So it's 21%. So it does not take what the market lost for you to gain. So you lost 17%, but the market needs to do 21% this year for you to break even. Right? So I have no confidence that the market is going to do 21%. It's not that I don't believe in the market. The market will perform. But I don't think it will perform this year, especially given everything that's going on. I mean, there are going to be some winners because of the losers, but the losers are going to fall on the American people, per usual. Volatility, I don't know why, I'm gonna eventually get that word right. There are just some words I'm gonna give up and just say it wrong. And then, so, you know, obviously you're at risk at any time of losing 100% of everything. Even the Chinese market had a 30-year downturn. I don't think that'll happen in America because we are a corporation. So we're a business, so it's always going to stay afloat in a way. But again, the American people are going to be the ones that suffer. So when I look back at the 23 average compared against my products, because what we do is we index. So you are participating in the upside of the market, but not the downside of the market. So there was a year where the market did negative 39%. So think about that, right? Think about where you could be in your life during that negative downturn. You may not have a hardship, but you might have lost a loved one. You may have had to change jobs, something happened to your kids. I don't know, you go through a divorce, whatever. There is a definite shift where your finances have changed dramatically. Imagine being in that point of the year where you've lost 39%. It's gone, that's it, right? And again, we've been there, we've seen it, I've watched it. And when I think about the vehicles I have, my clients will never experience that because they won't lose. Actually, when the market does not perform, they are guaranteed a 0.25% on their money still. And after the second year, depending on the strategies I'm looking at, a 1.5% or 1.25%, 1.25% no matter what. So no matter what, you're constantly seeing compound interest on your money. And then return averages. Like I said, the market always performs. I'm just looking at the losses, the taxes, and inflation that disrupt you having that financial stability when it comes to retirement or during your working years. Okay, so again, pulled this off website, stuff you can easily Google. So this is just the contribution pan. Some of them went up, and it's gonna be a lot of factors as to why contributions went up, but I'm always gonna say inflation and taxes. Those are always, I think about it as the cancers to our money, right? This is the sugar, right? Taxes is what's eating up our retirement. So again, talk about contribution limits, how much you're allowed to contribute to catch up, things of these nature, and we're gonna fly over. I don't wanna go too much into Roth IRA, but that's gonna be my next favorite one. Because the products that I have is what we call the rich man's Roth IRA, and we're gonna jump into Roth IRA as well. And again, none of these vehicles are awful. I always look at what it is that we do as an addition to your portfolio to diversify, have some guaranteed something that's going to be there and will not be in risk, almost like your little other savings plan. Because when I was early on in my career, I started off doing more life insurance sales, and I would always get scared when it came to the 401k stuff. I'm like, it's like calculus for me. Because most people would tell me, I don't like annuities, I don't like, IRA, or I don't like annuities or IULs, anything like that, because the verbiage that's being put out in the market by other big heads that, hey, this is my product, everybody else sucks. I don't believe that when it comes to insurance. I don't believe it's a one size fits all. It's not. It's a one size fits most. So as I got myself more educated, did a little bit more research, I found out some other cool things that I get to now, come up with that objection without hurting my client's feeling or making them feel like crap. So I'm just like, oh, do you like Social Security or pensions? They're like, yeah, getting that, right? They're all happy about that. Baby, that's an annuity, right? That is another form of, there's like 6 different forms of annuities, and that is one. That is something that you are contributing to, whether you like it or not, right? For your entire life, and that you are going to be receiving that dividend when you retire. So again, it's about mindset. What we're looking at, the information that we're consuming, we've consumed it one way for so long. When I bring this up, it makes it sound like I'm snake oil, right? Snake oil salesman, I'm blowing gas, right? So there. Okay, I think that's my next one is the Roth. My Roth, this is my favorite one because if a client brings this, I'm like, yes. I'm like, finish them, right? Not in a bad way, but it's the one thing that, hey, their friend, advisor, whatever is gonna try to combat me. Not that it's a competition. Again, I'm always trying to do what's best for the client. So I always encourage them, do your homework too. Yes?
Is it just a matter of depend on your situation, but do you believe traditional or Roth is a better way to go?
Yes, yes.
Yes and yes?
Absolutely.
Okay.
But this is the reason why it stinks. I would say absolutely yes. Use it if you can use it.
The traditional?
Over the traditional, it's just the thing is with Roth IRA, there's contribution and income limits. This is kind of like my segue to why it's like, hey, this one I have is a good thing for everyone. So with the Roth IRA, you're talking, I believe it's $6,500, $7,000 your contribution limits. So why people will choose this over the latter is because you're paying after tax dollars, you can pull the money tax free, all these good things, but you still are at risk for market loss. So those things are still going to be there. You're still going to have fees in some way or another. The reason why this does not work for everyone, because especially of us as entrepreneurs wanting to grow and expand our business, income limits. If you make more than 150K, 53K, but I'm rounding numbers, 153K, you cannot contribute to this. If you're a couple, 228K, you cannot contribute to this. So when we think about growing and expanding, it's like I have to stay under this just to do this. What are my other options where I can put more safe money in place? Whew, okay. All right, so I think this is where I kind of jump into IULs. All right, so what I do is I focus on indexed universal life insurance policy. This is where you are using life insurance. You're buying a small piece of life insurance and then we say, the government says, hey, we'll allow you to put a certain amount in without making us mad. Because life insurance is how a lot of businesses have been placed. You know Walt Disney? That's how Disney World got to be how it is today, because of insurance. So that's what I think about with these vehicles, because what we do is I give you the lowest possible amount of insurance I can give you, and I overfund the heck of it. So just to put it in layman's terms, let's just say the insurance costs $100, but government says I will allow you to put $1,000 additional into it. So the cost of insurance is all that you're paying for. That's what's so special about this. So you're exchanging something for something, right? Let's just do a $50,000 policy and say it's $100. It's just very nominal number. I'm exchanging that $100 for life insurance. So I'm not losing, versus when I put my money into traditional vehicles, I'm exchanging, but I'm putting in 100% risk. There is no death benefit when it comes to traditional vehicles. So I'm exchanging that, and it's allowing that any money outside of the cost of insurance is going to go into the cash value, which is seeing an average return of 7%. On the strategies that we have the historical look back. We're using the Barclays, and that one has an average return of just under 9% in the past 15 years. Like, that is massively huge. When you're comparing it next to the index, it's right up there, neck and neck. And again, even when you don't lose, you're still seeing a 1.25% on your money. So even the banks know these will do an average of 11 to 14% over time, which is why banks will buy millions of dollars of life insurance every single year, called BOLI, back-owned life insurance. So when you put your money in the bank and they give you a little, point something percent, they go and put it into these vehicles where they are compounding your money and making money on your money constantly.
Whose life is the insurance written on this?
You know me, I haven't done that much research yet. So when we think about that, it's like, well, if they're doing it, why aren't we doing it? That doesn't make sense. Why don't we know about this? Yes, how will the government make their money if we're not paying taxes, right? So, and that's why, like I said, as I became more educated, I would go into a house, I would see someone who had saved 500 grand into the 401k, and I'm like, well, man, you're doing great, man. Now I'm just like, hey, you're doing great. How much of that is yours? They're great, all of it. No. How much of that money is yours? If you were going to retire right now, how much of that can you take? There's a book that I recommend to my clients by Doug Andrew called The Laser Fund. He gives an example of the $1 million nest egg. In that nest egg, there's no risk to the market, There's no inflation, there's nothing. We're just saying, hey, this is $1 million nest that you have. If you wanted to live off of $30,000 a year, you would have to take out $50,000 because you're assuming a 33% tax rate when we know that's not where you're going to be at when you retire. Knowing that, and we're not including the loss of the market, that money is only going to last anywhere from 12 to 14 years. So you got to die before you're 80. You're just like, oh, 77 is coming up. Let me go say hi to the grands really quick and go on that trip around the world. We risk outliving our money, and that's what we're trying to do, is try to create a tax-free retirement where you do not live out your money and you can live comfortably. Moreover, sorry, not trying to lose my train of thought here, because I get going, I get running, I'm just like, oh, I'm nerding out. So again, that $500,000 will only last you 14, 12 years. And again, that does not consider inflation, loss of the market, things that are going to eat at your money, because inflation, like we said, it just takes away your buying power, right? Eggs are not $1, they're like 50, obviously I'm exaggerating, but it takes away your buying power. So when you think about that, that 50,000 or 30,000 that you'll be receiving, how much is it really, right? Maybe it's only worth 15,000 in the future from now. So it's more a concern for my generation, if anything, that terrifies me. So aside that, when we talk about retirement vehicles, all these things, a lot of times when you retire, what happens? When you retire, that life insurance policy that you have in your job, what happens? You get turned in, right? Like car keys, not every job allows you to roll your life insurance policy over. If you do, you lose that group plan advantage. And now they're talking about $400 or $500. You're like, whoa, what happened to that 15 cents or whatever, $1.20 I was paying for that, whatever. So you lose that and you have to turn that in. And now you are 65 and older, more, weight's a little bit more, not as active. You might have a couple more health issues that your family, hereditary. So now you're going to be looking at more pricier insurances, trying to get covered again at 65 years old. That's insane to think about it. And I've seen it, especially in this industry where incomes are way limited. And now we're having to see our older generation in the stores like, wow, it is honorable to have a good paying job. I don't think I should see a 70-year-old person being a greeter at Walmart. I think they should be at home making cookies and stuff. Like, I think they should be hanging with their grandkids and enjoying the rest of whatever's left. Again, I think about the life events that happen to you. We all know in this room people who have gotten cancer, caught in a car accident, gotten injured or hurt, lost a loved one, a spouse, whatever, that has changed the dynamics of their home and their financial status. There is nothing for that unless you buy outside resources, which a lot of people, that's not being handed to them. So even when you are at work and you go on disability, you're getting maybe 60% of your salary? That might not cut it if you're one family income, even if you're two family income, which most families are today. That's not gonna cut it. This is what I like about IULs. There's a couple of things that happen with it. It comes with living benefits. So you're talking about chronic, critical, and terminal illness rider. So if I get a heart attack, stroke, or I become disabled where I can't complete 2 of the daily living activities for at least 90 days or more. So that could be any reason. I have a client that fell at her school, right? She lives in Michigan, it was snowy, icy, she walked out on campus, slit, broke her damn leg. And then she got fired from work, she's not showing up. That's life, that's what happens. So now she's finally coming after this 3-4 year lawsuit where it's finally coming to a close. We're talking about 3-4 years. And she's got no money, she's got 2 kids. It's insane. That's scary, especially as a mother myself, that scares me. But if she had my vehicle, she could access 100% of her death benefit while she's still alive. No questions asked. They're just like, hey, have your doctor sign this and say it's for real, right? That you are gonna be immobile for 90 days or more. We will allow you to advance up to 100%, meaning you don't have to take it all. You can take a portion of it because you wanna make sure there's something there. And even when you think about that, think about what that could do to families who probably have taken out second mortgages or picked up extra jobs trying to make those medical payments and stuff like that. This is where you can put a buffer or prepare, right? Especially if we're talking about terminal illness and other things that might be debilitating, because a lot of times too, right, we could die, but what about if we live? You can get a car accident and live, but now I don't have legs or something, I can get cancer, but not die, but I might not be the same Patrice I was prior to cancer. So I think about that. And then now we're talking about the cash value, right? All that money we've been investing over time. And again, we can't call it an investment because it's a life insurance policy, but it's essentially what we are doing. You're putting it over time, then that life event happens, right? Market hits negative 39%. Guess what? Your money didn't touch. Maybe your job is, I had a lady who was a bus driver who, because of COVID, she wasn't working. And guess what? She didn't have a job. And guess what? She got cancer during the summer. and now she can't get insurance.
Mhm.
That's scary, you know? Say the situation is on job, you can access that money as a loan out of your policy tax-free because it's a loan. That's what they called it, to call it it's a very loaded word, but they had to because the banks are haters. I talk in like very,
What's the interest rate on them?
5%, I'm gonna get to that, that's the special part about it. So, it had to be changed though. There's a lot of this product and why it's not available widely, it's because of all the restrictions. It's heavily regulated because the banks don't like that. Even being able to fund a whole bunch of money that people used to get life insurance policies where you could put $100,000 in it and self-insure, so to speak, right? They took that away and said, no, we don't like that. You can only do that over time. So otherwise you'll net the policy, which is where we'll lose tax advantages. And if you pull out money, it's gonna tax all that money first. So then of course there's always loopholes for these bad boys. So even though you can only put it over time, because when you do that, that means you're leaving your money in the bank. It means they get to borrow it and do whatever they want. They can do whatever they want with it before they send it back to you, right? So insurance companies created other loopholes where there's PDA accounts, where we have premium deposit accounts where, hey, you can put that money in and it'll earn an average of a 3% interest rate, no risk. So if you decide to cancel, your principal is safe, but we're gonna take that interest. So it's like that little safe guarantee that you get, but it still allows you to put your money outside of the institutions. Then, mecking. A lot of times we think mecking is bad, where we're overfunding it and now it doesn't have tax advantages. Loophole is, if you don't touch that money, it will not be taxed and will still, if you die, it will still pass off tax-free to your beneficiaries. So if I get a milli and I'm like, I don't care, I'm making an average return of 7%, I'm gonna throw it in my policy because I have no intentions of touching it. It'll still pass off tax-free. So a lot of beautiful loopholes that are still created, but not everybody knows about those. So back to the cash value. When you pull that money out, it's a 5% charge, but it's not a rolling daily charge like your car or your mortgage or anything like that, where it's daily interest, accruing interest, $8, $9 a day, whatever it is. 1% charge. Since we're seeing an average of a 7% return, you're actually making 2% on that loan, and that's what we call arbitrage, where you're making more money than the money you just spent. And this is how you become your own bank. This is how you stop being in the bank system and be your own function, because even with these vehicles, you can have them wire money to you or send you a check. And so again, that's what's special about it. And because it's constantly making money, you do not have to pay those loans back. There is no rescheduled payment plan. So when you take that money back, that's not like your 401k, your IRA, whatever. You gotta put it back, right? You gotta put it back or they're gonna continue to penalize. I remember my dad pulled out money in his and he's like, I gotta put that money back, You know, and I remember that talk. You don't have to put it back here because your policy is constantly compounding. And then remember, even when you take, so if I had a bank account, I had $10,000, roof came in, and I had to pull out $5,000, right? Naturally, I would only have $5,000 left in my bank account. IUL, I pull out $5,000, it's still in there growing as if I didn't take it out because it's a loan, right? So it's still in there, compounding, getting that 7% hit, that average, and then the policy is paying itself back. It's like, oh, I'm coming for my check. It does it internally. So again, a lot of different ways to set this up, maximize your retirement, maximize your future. We don't just use this for retirement. We use this for business owners. Call it by different names, right? Different face. For us as self-employed, it's a CERP now, right? Self-employed retirement plan. I can use this for college retirement plans. I was running an illustration for my niece who's 5 years old. And I looked at it, and again, these are nominal numbers. This is what I choose to do. Contributing $250 for her for the next 18 years. By the time she's 18, we're looking at a nest egg, or by the time she's 23, we're looking at a nest egg about $90,000 that we can pull out of this policy. And let's say she went to college. I wish I knew about this when I was in college, and I took some of those loans that were the government funded ones with zero interest. Imagine pulling a $4,000 loan out for the government every quarter, and then I throw it into my life insurance policy. And then it's earning a 7% return. So in 4 years, I pulled that bad boy out, paid them off, and I just made over 7% on their money. Right. Think about maximizing what's available. Do what they've been doing, right? So I pulled that money out. Baby girl, the baby niece can pay off all her loans, everything. And guess what? I'm no longer paying on this policy anymore, but there's still a little cash value in there. Let's say I let it grow. I don't contribute anymore. By the time my niece is 65, she's looking at an average tax-free income. And I set it up for 20 years because I say my family, we pretty much tap out about 85. I set it up for about 20 years that she will receive that money. She's looking at an average of $100,000 every year tax-free for the rest of her life. And again, that's based off of a 6% that my illustration is showing when we are doing a 9% average. So realistically, she's only looking at a fraction of what's gonna be available to her, and she does not have to take it all. Even when I did my son's, I paid all the way till he's, well, I'm 65, so I'll do it for 30 years, paying $100 a month because I have these vehicles on my children, so I'm doing what I preach. By the time my son is 65, he's looking at 100 grand of income potential. By the time he is 78, he would take out $1.4 million of a policy I only paid 40 grand into and stopped paying on almost 30 years ago. And there is still a $600,000 death benefit that'll be paid out to his family. And that is it. My name is Patrice Johnson with Makarios Capital and Financial Services. So if you guys are interested in finding out more, even a consultation, no pressure, think about the grandkids, yourself, young adults, 20, 30, 40, 50 years old. This is something for them that they can play catch up and create a retirement that's going to be comfortable. Because even when I think about that 100 grand that my kids will have that income potential, even if it's only worth 50 grand tomorrow, that would still put a roof over their heads, and then they just gotta figure it out. And that's my way to say I love them beyond the grave, right? Take care of my babies even when I'm not here. And that's it. Thank you guys.